G'day and welcome to the Investor Motivation Podcast. My name's Robert Goudie and today I've got with me the lovely...
Rachael Todman.
G'day Rach, how are you?
I'm good, how are you going?
Easter time.
It is, looking forward to rolling into a long weekend.
Yeah,
It's been a busy week.
What's happening?
I'm going camping at Hatta.
Hatta.
So remotely, which will be good.
Sounds remote, fantastic.
Yeah, what about you?
Fishing at Wartook, which is a trout fishery that we have here in the Wimmera, which is pretty cool. We'll do that tomorrow morning and then catch up with one of my daughters in Melbourne on the weekend, on Sunday. That'll be awkward.
Lots of fun.
Awesome. I think I said awkward.
You did.
So today's topic, what are we going to chat about, Rach?
Just I guess the ups and downs of the markets, as we're all aware is happening at the moment and always does. Just some stats along with just some reassurance about asset classes, where we invest and why, taking a long-term approach as well, of course, with what we do. So
Yep. So this is very much around setting the expectation as to what we need to expect when we invest into share markets. And we've got the numbers in front of us here that show that investing into share markets, into businesses over the long term, give us the highest return.
Correct, yes.
They give us the highest return over a period of time, but they just don't work like that. And this is where investor psychology kicks in, which is definitely something that we've doubled down on as a business to explain to people what to expect and how to behave when things go bad.
Yeah, absolutely.
So we've just made a very big statement. We've got some numbers here over 20 years when we look at Australian shares. So when you think shares, we're talking about share market and Australian businesses or global businesses. So what are some of the numbers there, Rach?
Yeah, so for the Australian shares, average return over the last 20 years has been close to 8%. And then global shares is around 9.26%.
Cool.
So again, over a very long time, but
Yep. And if we went and had a look at the S&P 500 or the NASDAQ, that is probably an average that's closer to at least over 10 years is around 12.5%. So the American market, which is full of the very high value and very successful businesses, the Magnificent Seven, have shot the lights out. But the reason why we're pointing this out is because these are averages over long time frames, and they're accentuated with what, Rach?
The swings of the markets, the ups and downs, and the stuff that makes investors feel nervous at times. So if we wind back the clock, so again, looking over the last 20 years, 2008, the GFC was one that really rocked the boat.
Yes. Yep.
And then Australian share market was down around 38%, nearly 39%.
Cool.
So,
and what happened after a big down in the market, Rach, when people were probably the most nervous and scared and anxious about their investments, and particularly those that are leading into retirement, they get particularly scared and anxious about their scenario. What happened after 2008 when we were down nearly 40%?
So 2009 it was in reverse. So it swung up again by close to 38%. So within a small time frame, just goes to show short term how unpredictable things are.
Now I'm old enough to be around when the tech wreck was there. So I started in March 98 in this industry, and my first share market crash, I saw the bull run where the early tech businesses were shooting the lights out, and there was a huge run up in the late 90s to about 2000. And a lot of these businesses that people are overpaying for, so markets went through the roof, and then guess what happened? There was no profitability. Things came down, and that was a bear market that lasted around 3 years. It was tough going.
Yeah, definitely.
But the returns in 2004 was 10%. 2005 was 17%. This is global shares. 2006 was 11%. And then, of course, the GFC hit in 08, 09. And that's where things came down substantially. But again, like Rach said, in the Aussie markets, in 1 year later, if you lost nearly 40%, you got all that back.
Yeah.
The next year. Now it takes more of a percentage return to get back.
Yeah, of course. Yeah.
And this is the thing that we're very keen to highlight in this discussion, is that generally the best returns are after the worst returns.
That's right, yeah. When everyone's, nervous and fearful as well. It all just swings around in roundabouts.
Yeah. So when you are the most anxious, the most nervous, when you want to feel as though you want to go to cash or sell out, that will actually be the best time for you to do the exact opposite to what you're feeling.
Yeah, exactly. Either do nothing and be calm, or if you've got the opportunity and things are looking grim out there, then you can buy.
Yeah. Now, Rach, there was an awesome slide that we were just working off here that I don't think it's here, but it goes through and showed what happens if you missed the top 5 days, the best performing days in the market. You just missed those, and I reckon I've got the numbers in my head that if you missed the top 5 days in the last 10 years where the market rebounded, and what happened last week, Rach, when Trump came out and said, "Oh, look, we'll put this on a pause," and before he said that, he also said it was a great buying opportunity. We had one of those days. Yeah,
we did. Yeah, it was all grim. The Monday, I think, and then by Tuesday things were looking a little bit more optimistic.
So Monday was a big down day, and we did some light buying for our clients there. Tuesday was a bit ho-hum, but I think it might have been Wednesday night, and this when Trump came out and starts backpedaling, and Thursday was a 4% up. So that's an example of one of those big best performing days. But over the last 10 years, say the Aussie market returned, I think it's around, if the numbers are right, about 8.75%. If you missed this is 10-year time frame, just 5 of the best days, you reduced your return by about 2.7%.
It's incredible, isn't it? Such a short space. And
the top 10 days, guess how much you lost?
How much?
It was about 4.5%.
Yeah, right.
So out of an 8% return and this is over a 10-year time frame, you just missed the top 10 and you're down by half.
Yeah, so showing that trying to time the market, the impact it can have as well.
Yeah, and that's something I mentioned that we did a bit of buying there. We are mindful that we don't want to be buying in a peak. And the peak that we just saw recently was, all-time highs globally. It's time to be a little bit cautious because after the big run-up, we have a big run down. After we have a big run down,
up we go again.
Up we go again. And I think there was a really good quote, Rach, that you heard about talking about the roller coaster of share markets.
Yeah, so it was pretty much along the lines of the worst time to get off the roller coaster is when you're in the middle. Essentially keep your hands in the ride and just hang on.
Yep.
So do nothing. And
the only people that get hurt are the ones that get off halfway through.
Yeah.
Yep.
That's right. Yep.
And I think you've got a good example on that one, Rach, where during the GFC, and this is more of a hypothetical where I'll get you to explain it, Rach.
So it's essentially an example that we've been provided which shows 2 people investing $100,000 during the GFC. So investor 1, investor 2. So the first investor, they essentially stay the course. The second investor starts to get nervous and then decides to pull out their funds and sit it in cash for 12 months. So if we look at the first investor, the one that just sat tight, then you're looking at around 100,000 being valued at around 300. For the poor person that panicked, went to cash, theirs is around 225. So just shows that impact of staying on the roller coaster, not getting off midway, going through the duration.
Yeah, and they just sat at cash for that 12-month time frame, and so it went nowhere for that time because interest rates come down substantially. You didn't get a return. You got capital preservation, and that I suppose brings us to a discussion around for those people that, and in reading through comments on social media, on TikTok accounts where people are saying, "Yep, I moved to cash. I've done this." Those people that have made that decision now have another decision to make, don't they?
That's right, yeah. And as we've just seen from that example, the impact that it can have.
Yep, they've already missed one of those spectacular best days.
So that's all.
Now, more than likely there will be more volatility ahead. We saw that last night overseas again, which will translate to our markets today. But if you've moved to cash, you now have a decision to say, oh, you've got to go back in, because holding cash is not an investment strategy. It's a strategy to have your inflation, the value of your money eroded over time.
Yeah, that's right. Yeah, at some point, like you said, that decision's going to have to be made, and that feels stressful for that person as well. So they've been stressed, panicked, sold down, and then now they're potentially anxious again because they've got to work out what to do.
Yes, because inflation will be the biggest risk for that person that's too conservatively invested.
Yeah.
And I've seen it said, which is quite interesting. Well, I'll just get out, and I'll get out now because I'm too nervous, and I'll go back in, when I'm, I suppose when I'm feeling more confident in the market. And I know they don't know what they're saying, but they're saying, I will sell down now while the market is down, and then when I feel more confident is when the market will be up.
And I'll pay more for it.
So it's interesting.
Yeah.
There's just one chart here. We've got the best, this is Australian businesses. Out of the top 100, they've got the best 10 performing businesses up to the end of last year, and the 10 worst performing ones. And it's probably one we weren't going to chat about, but I thought it was just interesting.
Yeah.
So top of the charts there is Pro Medicus, which is awesome.
Yes.
Tech One, which is great. Some of our clients own that as well. Fisher and Paykel Healthcare is there, which
a few familiar names there.
Which is awesome.
Yeah.
But the average return over that 12-month time frame is 92.6% up. So nearly doubled your money if you owned all of those businesses. So highly unlikely you get them all right.
That's right.
But the reason why I brought it up was the top 10 worst performing, which is Min Resources, Pilbara, IDP Education, Ramsay, and that's IDP Education is definitely one we got wrong. So just for the flip side that we don't get it all right. No. But the average loss there is just under 33%. So we need to remember, at its core, businesses are run by people trying to make stuff better.
Yeah, yep.
And probably when I look through there, I see Viva Energy, Iluka, Paladin Energy, Fortescue. I see a lot of resources.
Yeah, which we steer clear of. So
correct.
Yeah.
So I think it's obviously
by default.
Yeah.
We've got a better result.
Yeah, that's right. And I think the reason why we stay clear of resources because they are price takers, not price makers. Very good. Dollar cost averaging rate.
Yes, believe we have another good example there.
I'll let you go through these examples and just explain that.
I'll borrow your page.
You can borrow my page.
Okay, so in this example they're comparing the outcomes for two investors. So one who invested $6,000 as a one-off, and then the other who invests $1,000 per month over 6 months. So it's talking about the difference here of obviously dollar cost averaging. So the first person that did the lump sum, so their value, so they started total investment $6,000, value after the 6 months was $4,800.
And this so this is all to do with the number of units they were buying and when they were buying.
Yeah.
Yes.
So the one that did it progressively, so did the $1,000 per month more regularly, so their value after 6 months was over $7,000.
Cool. So as the dollar cost average person, as the market was going down, they would just had it locked in, put $1,000 in each month.
Yeah.
Yep. And that's in these sort of times, that's an ideal thing to do.
Yeah.
I think it's worth noting with dollar cost averaging, it works in reverse as well.
Yes.
So that's that's the positive example where markets are trending down and we don't know where the bottom is, no one does, but as the share price or the unit price reduces, you're buying more units, getting more bang for your buck.
Yeah.
But that can work in reverse.
Yeah.
Where markets go up as well, so it's a double-edged blade as well. Now I think in Australia here we need to we have some home biases that I think are worth commenting on. It's a little bit off topic in terms of volatility and what's happening in the market. We don't need to talk about tariffs and Trump and...
I think we're all sick of
Yeah, that's right. I think
sticking to
that's well played out in the news.
Yeah.
But I think we just need good decision making at tough times. And one thing that we've done over the last 20 years, we have not been, we don't have that home bias where we just invest into Australia.
No, absolutely not.
And
no.
so we do know that some of the investment themes that are that have real tailwinds around them, which are the semiconductor business, AI, cloud storage, computing. A lot of these businesses are not based in Australia, and I think we need to be mindful of that.
Yes.
That of our market, around 55% is invested into two sectors only. That is, around 22% is in resources or materials, so that's your miners, and around 33% is within our big banks, the financials, which are holding. They're very good at paying a dividend, but from a growth point of view, from here, I just not so keen on.
Yeah.
So please remember this is general advice, but some of the best businesses, I believe, are outside of Australia. So
They are, yeah.
So you need to take a global view.
That's right. And also for diversification reasons as well. If one market or performs better than the other, then you've spread the risk as well. So.
Correct. Very good. Any other areas we need to cover off on just to help people through this time, Rach?
I think, just stay calm and carry on because, we don't know what's ahead and, no matter what we do, if we panic and pull out of the markets, it's not going to change the end result. So, sit tight and, take action where we can.
Cool. So what you mean by take action is potentially buying instead of selling when the news is bad?
Yes.
If people have cash to do so. If you don't have cash and it brings anxiety, you should do what?
Stay on the roller coaster.
Right.
Don't get off.
So what helps you stay on the roller coaster?
Big thing we say is don't look at your portfolio because if you're logging into your super every day or investment portfolio, it's not going to make you feel good. And especially with people in superannuation, my age, for example, we're not going to need access to it for a long time. Just staying on course and.
Yeah. So understand your time frame.
Correct. Yeah.
Okay. What about someone that's about to retire though, Rach? What's their time frame?
For the rest of their life, so they could be retiring at 65 and still be around at 100. So their investment time frame is still a long time.
True.
And definitely, again, we don't strip all our cash out or sell down our investments at retirement. We want to keep being invested for the long term.
So you can retire, but you can't retire your money.
Yeah, that old one.
Fantastic. Very good. Thank you,
Cool.
Rach.
Thanks, Rob.
All very well said. Please remember, at its core, the short term will be dictated by irrational, emotional, and anxious investors.
Yep.
Fear and greed, and we've seen the peak of greed in recent times, where the markets were all-time high.
That's right.
And during that time, at all-time highs, the inflows into markets were at all-time highs.
Everyone was feeling good.
Yeah, everyone was feeling good and are piling into the market.
Yeah.
And then when a bit of volatility, and the markets can do much worse than this, we don't know if it will, but they can, people go in reverse and the market goes on sale and everyone's running to the front door.
Yeah, that's right.
Terrific. Thanks, Rach.
Thanks, Rob.
Where can people find you?
TikTok and Instagram mainly when I'm active.
Cool. But you are there.
I am there.
Yep.
You, Rob?
Yep. Rob Goudie on TikTok. Please be mindful that there are lots of fake accounts there. I will never message anyone first. And definitely on Instagram as well. And our YouTube channel, where a lot of people do listen to this podcast.
Yeah.
There is over 750 videos there with lots and lots of videos.
Yes.
It's been a labour of love for a long time.
Yeah.
Thanks very much for joining. Thank you, Rach.
Thank you.
Cheers.
Bye.